At Chapter 18, problems in Chapter 18. So we start with this. This is problem number 4. So looking at problem number 4. But problem number 4 uses information given over here. This is the basic balance sheet and income statement that we are working off. So take a moment to kind of look through some of the important items over here that we have. We have sales, costs, without depreciation. Then that gives us EBITDA. Then we take out depreciation. That gives us EBIT. We take out interest expense. That gives us pre-tax income. We pay our taxes of that. That gives us net income. And over here on the balance sheet side, we have, on the current asset side, we have cash, accounts receivable, inventory. They add up to 2,100. We add long-term assets, plant, property, equipment, gives us total assets of 3,100. On the liability side, accounts payable is 1,500. That's my current liability. I add debt to it. Then I add, that gives me total liability. The remainder is stockholder equity. So that's a basic information that we have. Now, what we have to do in this problem, in problem number 4, it says, Jim expects sales to grow by 10% next year. That means the basic thing that is changing is this number. And using the percentage sales method, this is the key. Percentage sales method, forecast these items. Why I say this is the key? It means that all of the remaining items over here will be projected into the future at the same percentage of sales level that they are here. For example, how much is cost as a percentage of sales? So it is cost divided by sales. Cost is 100,000 divided by sale of 200,000. That means cost currently is 50% of sales. So now when I forecast the sales to grow, this number is going to grow, right? So this number, this number is going to grow. Sales number is going to grow. By how much? So forecasted sale will be 200,000 times 10%. That means 1.10. That will be 220,000. So based on this, I will forecast my costs at what? At 50% of 220. 50% of 220 is 110. Then I come to depreciation. Depreciation as a percentage of sales is 6,000 over 200,000. 6,000 over 200,000 is 3%. So now 3% of 220 would be 6,600. I come to net income. Net income is 60,840 divided by 200,000. As a percentage, that's 30.42, which is what we have here. Next, I will forecast this as 30.42, so 66,000 is 0.3042 multiplied by 220,000. That will give me 66,924. Same thing over here. Cash and equivalents, it's 15,000 divided by 200,000. That gives me a number of 7.50. So this number is now going to be, this number there is going to be 0.075 multiplied by 22000. And so on and so forth. So that's the way we can project one number and then restate our entire income statement and balance sheet based on this one projection, provided we are holding everything to the percent of sales method constant. Okay. So that's problem number 4. Now let's look at problem number 8. Same thing. Expect sales to grow by 8%. We're using the percentage of sales method, and we're going to hold everything constant. So what do? We look at, so sales is 186.7. What would be costs except depreciation? That'll be 175.1 divided by 186.7, that's 93.8. What would be depreciation as a percentage of sales? It'll be 1.2 divided by 1.86, that's 0.6. Okay, so that's what we would have. Now we are projecting that sales would grow by 8%. So this year it is 1.86, 186.7, it will be 201.6, which is 186.7 times 1.08. So once I have this 201, then this number over here is 93.8% of the previous line item, 201.6. That'll give me 189.1, and so on and so forth. And the same thing we can do on the balance sheet side. As we can see over here, cash is 23.2. 23.2 off 1.86 would be 12.4%. Next year, now, it'll be 12.4% off 201.6, which is this one, 201.6. That'll give me 25.1. So cash will move up because sales has moved up by 8%, and then so on and so forth. So that's pretty simple and straightforward. Same idea that we did in problem number 4, we are doing in problem number 5, essentially using the percent of sales method. So step number 1 is to take each of the line items over here and convert them into a percent of sales. Convert them into percentage of sales that we are looking over here. These are what we are getting as a percentage of sales, and then take the projection of the sales and then reconvert these numbers back based on the new projection of sales. Let's take a moment and look at problem number 9 using the same piece of information. It says assume that Global pays out 50% of its net income. Using the percent of sales method, forecast stockholder equity. So we are working off the same numbers. What would be first? Net income over here, based on forecasts. Okay, so net income is 2. What would be net income next period? It would be 2.6. As we work all of the numbers, as once we have this number that tells us what this number is, then we forecast this number, that tells us what this number is going to be. Interest expense does not change, it's constant, because that's obligatory, that is fixed from previous, so that keeps this number. Taxes, we pay 26% tax off the pre-tax income, so that this number over here is 0.26 times 3.5, so that's 0.9 negative. That gives me a net income of 2.6. So that's my net income. Okay. Sales method to forecast stockholder equity. So it is going to pay 50% of net income. So net income is 2.6. It's going to pay out 50% of 2.6. Right, so 50% of 2.6 would be paid out. So that would be 1.3. We'll have 1.3. 1.3 would be my retained earnings. 1.3 is retained earnings. So this 1.3 is my retained earnings. I had income of 2.6. I paid 1.3 out as dividends, so I have 1.3 left over. What does that 1.3 do to my new stockholder equity? The old stockholder equity was 22.2, right here. So the new stockholder equity, or forecasted stockholder equity, new stockholder equity would be 22.2 plus 1.3. 23.5 would be the new number. This is a slightly different number than you would see in your solution manual, but use this number because we are using 2.6 over here. The solution manual has a slight error in the numbers there. So follow this method or this solution. Let's look at problem number 16. The problem states that you have a company with these pieces of information and it's asking you to calculate internal rate of growth. So internal growth rate is given by, we take net income, divide that by assets, and multiply that by 1 minus the payout ratio. So net income is 50,000. Beginning total assets is 400,000. Payout ratio is 0. That means everything is being retained, nothing is being paid out. So 1 minus 0. That would give us an internal growth rate. 50,000 divided by 400,000 is 12.5%. 0.125 or 12.5%. So that's my internal rate of growth. What's my sustainable rate of growth? Is my net income divided by equity times 1 minus payout ratio. So this will be 50,000 divided by 250,000 times 1 minus payout over here is again 0. So that would be 20%. So internal rate of growth is 12.5%, but sustainable growth is 20%. What would happen to sustainable growth if it paid out 40% as dividend? If it paid out 40% as dividend, where will the change occur? Change would occur here. Dividend is now 40%. That means payout is 0.4. So this would be 50,000 divided by 250 times 0.6. So I multiply this by 0.6. 1 minus 0.4 is 0.6. And that will give me 12%. So part C answer would be 12%. And so that completes our tutorial on chapter 18.